Lesson 9. Time range testing. Let me tell you a story I've seen play out more times than I can count. Simone builds a strategy. They backtest it over the first 6 months of 2025. And the numbers are gorgeous. 35% return, 92% win rate. Sharpe ratio of 4.5. They're thrilled. They show their friends, they start thinking about what they'll do with the profits. And then they run the same strategy over the next 3 months, July through September, and it loses 8%. Win rate collapses to 45%. Sharpe drops to 0.3. Same strategy. Same code. Same markets. Completely different result. What happened? That is the question this lesson is about. And the answer, in a word, is overfitting. Or possibly that the strategy only worked in one specific kind of market, and the market changed. Either way, the lesson is the same. A single backtest over a single time period tells you almost nothing. If you want to know whether a strategy is real, you have to test it across many time periods, in many kinds of markets, and on data it has never seen. Why one backtest is never enough? There are really 3 reasons you need to test across multiple time ranges, and they all flow into each other. The first is to catch overfitting, which I already hinted at. Overfitting is what happens when you tune a strategy so tightly to one slice of history that it memorizes that slice instead of learning anything general. It looks brilliant in the past and falls apart in the future. We talked about this back in lesson 1, but now you need to see it concretely. The pattern is always the same. Beautiful numbers in the period you develop the strategy on. Ugly numbers the moment you test on something new. If you only ever backtest over one stretch of time, you'll never catch this. The single backtest will look amazing, and you'll never know it is a mirage. The second reason is to check consistency. A strategy that makes 45% in one quarter, loses 15% in the next, makes 30% after that, and then loses 20%, is a very different animal from one that grinds out 8, 12, 9, 11% across 4 quarters. The average might look similar, but the first one is gambling and the second one is a strategy. Real strategies have a signature. They're reasonably stable. The drawdowns stay within a band. The win rate doesn't bounce around like a yo-yo. When you see consistency across multiple periods, that is signal. When you see wild swings, that is noise. And it usually means your edge isn't really there. The third reason is that different strategies are built for different markets. And if you only test in one market type, you might completely miss what your strategy is actually good at. A trend-following strategy is going to look like a genius in a bull market and bleed out slowly in a choppy sideways market. A mean reversion strategy is the opposite. It prints money when prices bounce around in a range and gets chopped to pieces when the market trends hard. If you build a trend strategy and you only happen to backtest it during a strong bull run, you'll think you've invented a money machine. Then the market goes sideways for 3 months, and you can't figure out why your bot is suddenly losing every trade. So that is the why. Catch overfitting, confirm consistency, and figure out what kind of market your strategy is actually built for. 3 kinds of markets you need to know before we get into the mechanics of how to split up your data. Let me talk about market types, because this part genuinely matters and a lot of beginners skip past it. Markets come in 3 basic flavors, and your strategy is going to behave differently in each. A bull market is what everyone loves. Prices trending up over weeks or months, gains of 20% or more. Pullbacks that are shallow, volumes rising, sentiment optimistic. The classic picture: if you slap a 50-day moving average on the chart, you'll see price staying above it and the average itself sloping upward. Trend following and momentum strategies shine here. Mean reversion strategies, the ones that try to sell the top and buy the bottom of small swings, tend to struggle, because in a strong bull market there is no top to sell. A bear market is the mirror image. Prices grinding down over weeks or months, declines of 20% or more, rebounds that get sold off quickly, falling volume, pessimistic sentiment. Price sits below the 50-day average, and the average slopes downward. Most strategies that work in a bull market stop working here, often badly. This is where you find out whether your stop losses are real or just decorative, and where you find out whether you have the temperament to keep a bot running while it is losing. Honestly, in a bear market, the right answer for a lot of people is to trade smaller, raise their stop standards, or just pause trading altogether. There is no shame in that. The third type is the range-bound market. sometimes called sideways or choppy. Price oscillates inside a band for days or weeks, never really committing to a direction. The fluctuation over 30 days might be under 15%. Volume is moderate. Sentiment is neutral. This is where mean reversion, grid trading, and RSI overbought, oversold strategies do their best work. And it is where trend strategies die a slow death by 1,000 small losses. Because every time they spot what looks like a breakout, the market reverses and stops them out. You can identify these visually. Open a chart, put a 50-day and a 200-day moving average on it, and just look at the last 6 to 12 months. Price above both averages with the averages rising. That is a bull. Price below both with the averages falling. That is a bear. Price wobbling around a flat 50-day average. That is a range. The point isn't to be precise about it. The point is to know roughly which kind of market you are looking at, because your strategy is going to behave differently in each one. Out of sample testing, the single most important habit. Now, let's get into the actual technique. Out of sample testing is, in my opinion, the most important thing you'll learn in this entire course. If you only adopt one habit from these lessons, make it this one. The idea is simple. You take your historical data and you split it into two pieces. The first piece is your training set, also called in-sample. This is where you build your strategy, tune your parameters, fiddle with your indicators, do all the messy creative work. The second piece is your testing set, also called out of sample. This is data you have not touched, you have not looked at it, you have not optimized for it. You only run your finished strategy on it once at the end as a final exam. Why does this matter? Because every time you tune a parameter, you are leaking information from the data into your strategy. If you tune against the same data you test against, the test becomes meaningless. It is like a teacher giving the class the exam questions in advance, and then acting surprised when everyone scores 100. Of course they did. You saw the questions. The only honest test is on data your strategy has never seen. The classic split is around 70-30. If you have 15 months of data, use roughly the first 9 months as your training set and the last 6 months as your testing set. Build your strategy on the first 9 months. Get it to a place where you are happy. Then, and only then, run it on the final 6 months and look at the numbers. What you are looking for is simple. You want the test period to perform somewhere close to the training period. Not identical because markets are noisy and you'll always lose a little performance out of sample, but close. A reasonable rule of thumb is that if your test period delivers at least 75% of the training period's return and Sharpe, and the drawdown doesn't blow up to more than about 1.5 times the training drawdown, you have something real. If the test period falls off a cliff, returning say 2% against a training return of 30%, you have overfit. Throw it out and start over. I know that is painful. You spent days on this strategy, but the alternative is losing real money on it next month. The backtest is free. Real money is not. Walk forward testing. The grown-up version, the 70-30 split, is the basic version. There is a more thorough approach called walk forward testing. And once you are comfortable with the basics, I really do recommend you try it. The idea is that instead of one big split, you roll through the data in overlapping windows. Take 12 months. Train on January through June. Test on July and August, then slide forward. Train on March through August. Test on September and October, then slide again. Train on May through October. Test on November and December. Why bother? Because a single split is still vulnerable to bad luck. Maybe your test period happened to be an unusually calm stretch, or an unusually wild one. By rolling through several windows, you smooth that out. You see how the strategy behaves across multiple slices of market conditions, and you get a much more honest picture. It is more work. Yes, you are running backtests multiple times instead of once, but the discipline pays for itself. If a strategy holds up across 3 or 4 walk-forward windows, your confidence should be much higher than after a single split. And honestly, if it doesn't hold up, you'd much rather find out now than after going live. There is also a simpler cousin of walk-forward that I'll mention, which is just quarterly testing. Run your strategy separately on Q1, Q2, Q3, Q4, and look at how the numbers compare. You are not training and testing here, you are just checking for consistency. If the quarterly numbers are reasonably close to each other, your strategy is stable. If they swing wildly from quarter to quarter, something is wrong. How to spot overfitting before it costs you? Let me give you some concrete warning signs. Because overfitting rarely announces itself. You have to look for it. The most obvious sign is what we already talked about. Great in training, terrible in testing. If you see a strategy with a 95% win rate in the development period and a 48% win rate out of sample, you don't have a strategy. You have a memory of one. The second sign is parameter complexity. I've seen strategies where the entry condition is built out of 10 different indicators chained together with and each indicator has a threshold tuned to 2 decimal places. RIZ greater than 52.3 and less than 57.8. Massachusetts CD greater than 0.023. Volume greater than 1.234 times yesterday's volume, and so on. When you see thresholds that precise, you should hear alarm bells. Those numbers didn't come from theory. They came from someone scrolling through backtests until the equity curve looked pretty. That is not a strategy, that is a fingerprint of one specific dataset. The third sign is what I call parameter fragility. Run the same strategy with RSI at 30, at 31, and at 29. If the return jumps from plus 25 to plus 2 to minus 5, your strategy is balanced on a knife edge. Real edges are robust. Move a parameter by a small amount and the result should move by a small amount. If small changes blow up your results, you've fit to noise. How to keep yourself honest? So how do you prevent this in the first place? There are a few habits that I think make a real difference. Keep your strategies simple. 3 to 5 conditions in your entry logic is plenty. Use round numbers for your parameters when you can. 30. Not 30.3. The rounder the number, the less likely it is a fingerprint, and every condition should have a reason behind it that you can explain in plain English. If you can't explain why an indicator is there, it probably shouldn't be. This is huge and people constantly underestimate it. If you are running a strategy on a 15-minute time frame, 3 months is not enough. You want at least 3 months, ideally 6 for short time frames. For hourly strategies, 6 months minimum. For daily strategies, a full year minimum. More is better. The more history your strategy has survived, the more confidence you can have. Test across market types. Run your strategy on a bull stretch, a bear stretch, and a sideways stretch. If it survives all 3, you've got something genuinely robust. If it only works in one of them, that is not a flaw, that is information. Now you know what kind of market this strategy belongs in, and you know not to run it when conditions change. Test parameter stability. Nudge each parameter a little in both directions, and rerun the backtest. If the results stay reasonable across small nudges, you have a robust strategy. If the results collapse, you've overfit and you need to back off. And finally, use what you might call regularization, borrowing a term from machine learning. Don't let your strategy get too aggressive. Cap the number of simultaneous positions. Use a stop loss that isn't absurdly tight. Set ROI targets that are achievable rather than fantastical. The looser and more conservative your settings, the less room the strategy has to memorize one specific dataset. Tight settings are how you accidentally curve fit to history. The honest takeaway, let me land this lesson on something honest. Time range testing is not glamorous. It is not the fun part. The fun part is building a strategy and watching the equity curve climb on a beautiful backtest. Testing across periods, doing walk-forward runs, checking for parameter fragility, throwing out strategies that looked amazing but failed out of sample. All of that is work. It is slow, methodical, slightly tedious work. But it is the work that separates people who last in this game from people who blow up their accounts in the first quarter. A strategy that survives honest, multi-period, out-of-sample testing is rare. Most ideas don't make it through. That is the truth. But the ones that do make it through, you can run those with real confidence. You know they're not a fluke of one lucky stretch of history. You know they hold up across different markets. You know the parameters aren't balanced on a knife's edge. And here is the deeper point. Consistency matters more than peak returns. I would take a strategy that returns 10% a year, every year, with shallow drawdowns, over one that sometimes returns 50% and sometimes loses 30%. The first one compounds quietly and lets you sleep. The second one is a roller coaster that eventually makes you do something stupid at exactly the wrong moment. When you are testing across time ranges, you are really hunting for that quiet, consistent, boring strategy. Boring is good. Boring is what makes money in the long run. So that is the lesson. Don't trust a single backtest. Split your data into training and testing. Test across different markets and different periods. Watch for the warning signs of overfitting. Keep your strategies simple and your parameters round. And remember that the goal isn't a backtest that looks amazing. The goal is a strategy that actually holds up when you put real money behind it.